Stop scrolling. Stop everything. The silver price you see on your screen? It's a lie. Not a small one, not a glitch. It's a massive disconnect from reality. While COMEX shows $70 per ounce, Shanghai is paying $84.55. That's 18% higher. And no, it's not a typo. This is a full-blown fracture in the global silver market. If you're looking at charts and thinking, you understand what's happening, you don't. Here's what's really going on. The silver market has split into three distinct worlds. World 1, Shanghai. Panic is everywhere. Factories, conglomerates, industrial giants, they're buying everything they can before China's export ban hits on January 2nd. $84.55 per ounce isn't just a price, it's a warning. This is what the real market says, not what paper contracts try to convince you of. World 2, Dubai and UAE. Physical silver here is trading at $79, $80 per ounce. It's tight, but not catastrophic. Yet. This is where serious industrial buyers are hedging, prepaying for physical silver to secure supply. World 3, COMEX. $72 per ounce. Paper contracts, zombie prices. The gap between Shanghai and COMEX isn't just widening, it's exploding. $12 difference in a day. That's 17% in a single session. Physics says this shouldn't happen, but the market doesn't care about physics. It cares about delivery. Why the gap? Because arbitrage is impossible right now. Buy in New York, ship to Shanghai. By the time the silver arrives, the export ban will be in effect. The bridge is burning and no paper contract can change that. Delivery numbers tell the story no chart can. Yesterday, 69 contracts. Today, 1,847 contracts. That's roughly 9.2 million ounces demanded in a single day. Compare that to a normal day. This is insane. Banks thought they could cover paper shorts easily. They were wrong. If you thought $72 was a safe floor, think again. The COMEX price is irrelevant. The market reality is dictated by physical demand, and right now, Shanghai is calling the shots. Banks are sweating. Emergency liquidity injections of $5.8 billion in the last 48 hours are not a suggestion. They're a lifeline. Hedge funds, banks, even arbitrage traders, they're trapped. Buy physical silver high, sell low on paper, bleed cash to cover deliveries. This isn't a trading. This is a full-blown market crisis. Inventory movements confirm it. Shanghai vaults have been emptied at a staggering rate. 41 tons yesterday, 43 tons today. That's 2.7 million ounces vanishing from registered inventory in just 2 days. Normal withdrawals are 2-3 tons per day. Panic withdrawals are 42 tons per day. Who's buying? Not casual investors. This is industrial giants and conglomerates front-running the ban, hoarding physical silver as their factories depend on it, because they do. Meanwhile, the physical premium is spiking. U.S. Silver Eagles are trading $12 above spot, generic rounds $8 over. The paper market pretends everything is fine, but reality is screaming, COMEX is obsolete. You don't have time to wait. The next 36 hours will determine which buyers survive the ban and which are left staring at charts while the real price moves far beyond their grasp. This is the fracture, the reset, and the ultimate warning. If you're watching from the sidelines, the market is already leaving you behind. The numbers are terrifying. 1,647 delivery contracts today. That's 9.2 million ounces of silver suddenly demanded. Yesterday, 345,000 ounces. The system isn't moving, it's exploding. This isn't just volume, it's a panic event. Think about what this means for the banks on the other side of the trade, likely JP Morgan, Citi, Bank of America. They sold paper contracts, expecting buyers to roll forward. Now every contract is a demand for physical metal. Deliver or default? That's 9.2 million ounces they have to source today. And the open market is broken. Shanghai is at $84.55, Dubai is at $79.61, and COMEX is at $72. Delivering means buying high and selling low, cash bleeding out of their balance sheets faster than any chart can show. The Fed has had to step in. $5.8 billion of emergency liquidity in 48 hours. That's not a routine repo. That's just a life support system for a banking system facing a metal shortage it cannot cover. The paper market can't print silver. Dollars won't help if the vaults are empty. Every injection is just a patch over a widening structural crack. Banks are scrambling. Reports from trading desks reveal massive provisioning. JP Morgan adding $400 million for potential losses in commodities overnight. Citibank is slowing delivery timelines. Bank of America is extending delivery windows from 2 days to 2 weeks. The reason? They simply cannot source enough physical metal fast enough. This is the classic bank-run dynamic, except it's industrial silver instead of ATM withdrawals. Meanwhile, Shanghai is accelerating from a vacuum operation to total depletion. Yesterday, 41 tons withdrawn. Today, 43 tons. 84 tons in 48 hours. That's roughly 2.7 million troy ounces pulled from registered stock. Normally, 2 to 3 tons per day move. Now, 42 tons per day. The smart money in China isn't just buying. They re-vacuuming the market clean ahead of the January 2nd export ban. And the implications go beyond Shanghai. Each ounce removed is permanently out of global arbitrage. Western banks, already short millions of ounces, are staring at empty vaults they assumed they could tap. COMEX paper contracts? Meaningless. The physical market has already decided the real price, $84.55, not $72. The industrial panic is contagious. Corporate boardrooms are acting. Samsung has executed emergency procurement for 6 months of silver supply. Tesla is doing the same for EV batteries and solar roofs. When megacorporations start hoarding, every ounce they buy is one less ounce for the market. This isn't speculation. This is survival. Factories cannot function without silver. Production lines halt, products stop, profits vanish. And it's not just Asia. North American dealers are seeing premiums spike, reflecting the shortage. Silver Eagles, $12 above spot. Generics, $8 above. These premiums aren't a whim. They're a reflection of true scarcity. The paper market is a ghost. The real world has already repriced silver. Now, picture the mechanics. Banks have a choice. Deliver metal they don't have and bankrupt themselves, or scramble to source it, paying 10+ers per ounce above paper. Either path burns cash, either path exposes the structural fragility of the system. And with the Fed pumping billions to keep things afloat, it's clear. The era of paper silver is ending. This is the calm before the storm. If you're watching charts, you might think $72 is safe. If you're watching delivery data, you know the truth. Supply is collapsing, demand is frenzied, and the arbitrage bridges are burning. The physical market now dictates the price, and COMEX is just a fading echo. In 36 hours, when China's export ban becomes law, everything will accelerate. The floodgates will close, premiums will spike, and the paper market will finally have to reckon with the reality it has ignored for decades. Banks, traders, hedge funds, they're bracing, but they cannot stop what's coming. The real question for traders, investors, and anyone watching silver, are you ready to be on the right side of this collapse? Every ounce you hold now, every physical contract you secure, is a hedge against the chaos that will hit the ticker screens, but not the vaults. The market isn't slowing down. It's accelerating toward a critical juncture. Shanghai is emptying, banks are scrambling, industrial giants are hoarding, and the clock is ticking. Every hour brings us closer to a price reset that could shock the world. While the banks scramble and Shanghai bleeds metal, the real story is the industrial panic spreading through corporate boardrooms. This isn't small-time panic buying. This is the world's largest manufacturers realizing that without silver, their factories will go dark in February. Samsung is first in line. Normally they hold 2 weeks of inventory. Overnight, they've locked in 6 months of supply. That's 26 weeks of metal snatched off the market in one move. Tesla isn't far behind, pushing emergency purchases for EV batteries and solar roofs. Apple, Chinese solar giants, the tier 1 electronic suppliers, they're all bidding above spot, ignoring charts, ignoring paper prices, because for them, the cost of zero silver is far worse than paying a premium. Let's break it down. China controls 80% of global solar panel production. The new TOPCon solar tech consumes 50% more silver than older panels. With the export ban looming in 36 hours, Chinese manufacturers are hoovering every ounce they can. That 84-ton vacuum we saw isn't speculation, it's strategic resource capture. They are securing their energy future while the rest of the world waits for paper prices to catch up. And it's not just Asia. North American coin dealers and wholesalers are reporting massive premium spikes. A U.S. Silver Eagle isn't $70, it's $84. Generic rounds? $8 over spot, when normally they're under $1. Retail is reflecting the real supply-demand crisis, while COMEX remains detached, showing a ghost price. This disconnect between paper and reality is spreading contagion style. Factories, refiners, and mints are panicking. APMEX, JM Bullion, major suppliers, they're pulling inventory offline. Pre-order, 6-week shipping is the new normal. That's code. They cannot source silver, they don't know when they will. And this is just the tip. The feedback loop is terrifying. Every corporate panic order removes metal from circulation, which drives up premiums for the next buyer. Each withdrawal from Shanghai makes arbitrage impossible, which in turn forces Western banks to bleed cash trying to fulfill delivery contracts. Every ounce bought by Samsung or Tesla is an ounce the Fed-backed banks cannot access. The bridge between paper and physical is collapsing fast. Meanwhile, the Chinese solar giants are not just hoarding, they're planning for decades of dominance. They are taking the atoms, securing them in advance of government restrictions, and ensuring that while the West waits for New York to catch up, China will control the supply chain for the next energy transition. This is not market manipulation. It's geopolitical foresight, executed with industrial precision. Back in the US, retail and corporate buyers are now mirroring the frenzy. Dealers report clients paying $10 to $12 above spot, not for speculation, but because physical metal is the only certainty left. Charts, tickers, and technicals are irrelevant when delivery is the only measure of truth, and the trickle-down effect is accelerating. Industrial panic drives retail panic, which drives premium spikes, which drives banks into liquidity death spirals. The system is no longer functioning in layers. It's a single, interconnected panic loop. COMEX can no longer act as a stabilizer. It has become a museum of outdated paper contracts, a remnant of a world that physically no longer exists. Now, imagine this through the lens of timing. Less than 36 hours until the China export ban. The countdown is not theoretical, it is operational. Every purchase, every delivery notice, every premium spike is a signal. Samsung's 6-month procurement, Tesla's emergency buys, the Shanghai 84-ton vacuum, all of this tells us the supply chain is about to freeze. The implications are clear. When markets reopen post-ban, the paper price will no longer matter. The only price that counts is physical. That's the $84 in Shanghai, the $84 at your dealer, the $84 in industrial vaults. Anything else is fantasy, and for the traders, hedge funds, and banks still holding paper, that fantasy is about to explode into a real-world margin call. This is the beginning of the Silvergeddon event, where the industrial and strategic hoarders dictate the market, and COMEX is left scrambling for credibility. Every premium, every withdrawal, every desperate corporate order is fuel on a fire that cannot be stopped. Now, we arrive at the final phase. The clock is ticking down to Friday, January 2nd, 2026, the day the China export ban becomes law. This is not just another market event. This is a reset of global silver pricing, and the moment the paper market loses all credibility, Phase 1 is already underway. Less than 12 hours remain before the global market shut down for the New Year holiday. Shanghai Futures Exchange is about to close its doors, and COMEX will follow later today. This is the last window for liquidity, the final chance for paper shorts to cover positions, and the final opportunity to secure physical metal before the premiums explode. Expect volatility. The banks might try to crush the price to $70 to trigger stops, or they might capitulate and send it to $75. But remember, the price on the screen doesn't T-matter, possession does. If you don't have metal in your hands when the bell rings, you're left behind. Phase 2 is the void, Thursday, January 1st. The markets are dark, the screens are silent, but the system is not asleep. While the world celebrates, risk managers at JP Morgan, Citibank, and Goldman Sachs are in emergency sessions. They see the 84-ton hole in Shanghai, the 1,847 delivery notices, and they know the real crisis is coming. Thursday will see industrial panic go into overdrive. CEOs from Samsung, Tesla, and others will call refiners, suppliers, and brokers, securing metal off-market, paying premiums that would make your head spin. These trades won't show up on charts, but they will dictate Friday's reality. Then comes Phase 3, Silvergeddon, Friday morning, January 2nd. The markets reopen, the China export ban is active, and arbitrage is mathematically impossible. The New York paper price cannot open at $72 when Shanghai is trading at $84 with the supply chain locked. Expect an instant gap up of historic proportions. Silver may spike to $78, $80, or $82 within moments. The price is secondary. The real story is force majeure declarations, where dealers, refiners, and suppliers legally admit they cannot deliver physical metal. They offer cash settlements at paper prices, but the market wants the physical asset, the $84 metal. This is where lawsuits will start, premiums will explode, and the paper market's credibility will vanish. Watch the spread closely. If the current $12.40 premium today seems large, don't be shocked if it hits $15 or even $20 by Friday. Dealers will move to no-offer status, online inventories will vanish, pre-orders will stretch into months, physical demand and industrial necessity will dictate the market, not charts, not tickers, not algorithms. We are witnessing a complete transfer of wealth. For 40 years, paper manipulators suppressed the price to siphon value from physical holders. That era ends now. The buffers are gone. China removed the physical cushion, the Fed exhausted the liquidity, industrial buyers drained inventory. There's only one measure left: supply versus demand in the physical world. This is the final warning. Do not fear the red candles. They represent paper liquidations, not true market value. Look at them and feel pity for those selling real assets for fake prices. You, the informed holder, are on the winning side. You hold the metal that Samsung needs, that Tesla needs, and that China is hoarding. You own the asset that cannot be printed, hacked, or defaulted on. The era of paper silver is over. The era of strategic silver begins now. The next 36 hours will define the market for years. When the opening bell rings on Friday, the world will see a price reset the likes of which we've never witnessed. This is not speculation. This is not panic for panic's sake. This is a realignment of physical reality against paper fantasy. Hold fast, stay alert, and prepare for the repricing of a lifetime. The countdown is almost over, and the Silvergeddon event is here. Those who understand, who act, and who hold will emerge on the winning side of history. This is Jason from JW Capital. The warning is delivered. The timeline is set. Be ready for the gap. Share your prediction and comment. Like, share, and subscribe. I will see you in the next video.